June 21, 2026. Fintech and Markets, Mapping Tomorrow's Financial Frontiers. Corporate Treasury and Cash Flow Management. CFOs bet on AI and digital dollars to supercharge liquidity. In the corporate treasury world, a quiet revolution is underway as CFOs seize new financial conditions and technologies to transform how they manage cash. After years of near-zero interest rates, a yield-rich environment has thrust corporate cash holdings back into the spotlight. For global e-commerce giants and retailers, the billions sitting in their treasuries have become strategic assets that, if managed astutely, can generate notable returns and insulate companies against economic turbulence. CFOs are responding by sharpening cash flow forecasts and actively investing surplus funds into higher-yielding short-term instruments, even as they maintain agility to quickly deploy capital into growth opportunities. The result is a new kind of mission control approach to liquidity, companies seeking to maximize every basis point of return, treating cash reserves as the rocket fuel for their next phase of expansion. A notable example this month shows how technology is democratizing advanced treasury management. New York-based Fintech Ramp, a platform used by tens of thousands of companies for spend management, announced a partnership with Moment, an AI-powered investment engine, to integrate institutional-grade fixed-income investing right into corporate finance workflows. Even mid-sized businesses can now automatically sweep excess cash from their operating accounts into professionally managed bond portfolios within minutes, a task that once took dedicated treasury teams weeks of manual effort. This collaboration illustrates how fintech innovation is bridging the gap between everyday corporate finance and high-end asset management, enabling CFOs to handle cash with the sophistication of Wall Street titans while freeing up their teams for strategic planning. Meanwhile, an industry advisory group of veteran treasurers has published a roadmap for tokenized cash management, outlining how blockchain-based digital money can be woven into everyday treasury operations. From on-chain vendor payments and instant intercompany transfers to automated overnight investments in tokenized money market funds. Such developments signal that corporate finance is preparing for an era of real-time, always-on global money movement. From a legal perspective, corporate treasurers are cautiously venturing into digital assets as part of their cash strategy now that regulators have provided much-needed clarity on previously murky territory. The Genius Act, passed in mid-2025, was a game-changer. It eliminated key regulatory uncertainties around stablecoins, digital currencies pegged to fiat money, effectively giving companies a green light to explore them as liquidity tools. This newfound confidence means CFOs can consider holding stablecoins like USDC for near-instant, low-cost cross-border transfers without the specter of a compliance backlash, as long as they maintain robust controls. Banks and accounting firms are expanding crypto services to meet this demand, helping companies integrate digital dollars into their treasuries in a compliant way. Especially for e-commerce platforms that must pay thousands of small sellers around the world in different currencies, stablecoins offer near-immediate 24/7 settlement and dramatically lower fees compared to wire transfers. While prudent finance chiefs remain mindful of volatility, cybersecurity, and fiduciary duties, many see digital dollars as a tantalizing new tool for real-time liquidity management and incremental yield. In a volatile global economy, and with commerce potentially extending to new frontiers, corporate treasurers are evolving to ensure their businesses have the fuel to sustain growth on this planet and beyond. Enterprise Risk Management, ERM, from crisis to competitive edge, turning threats into resilience. Enterprise risk managers in 2026 face a world of overlapping uncertainties and fast-changing threats. The risk landscape now encompasses everything from cyber-attacks on e-commerce platforms and AI-driven fraud to supply chain disruptions and climate-related disasters. In response, forward-looking companies are transforming risk management from a narrow compliance function into a proactive driver of strategy and resilience. ERM teams are leveraging powerful predictive analytics and artificial intelligence to simulate potential crises and stress-test their defenses long before real trouble hits, ensuring continuity across global operations. Like navigators charting a course through unpredictable cosmic weather, today's risk leaders monitor a constellation of hazards in real time, whether financial, technological, or geopolitical, to safeguard corporate value and maintain trust among customers and investors. By treating risk events as potential catalysts for improvement rather than just threats to avoid, companies are cultivating a culture of agility and preparedness that can turn adversity into an opportunity to strengthen the business. A surge in complex digital fraud is underscoring the urgency of this shift. New data unveiled at a major fintech conference in Europe indicates that global payment fraud rates have jumped roughly 25% over the past year. A clear signal that cybercriminals are exploiting shared online infrastructure and AI-driven scams to outpace legacy controls. In the face of these escalating threats, organizations are doubling down on next-generation risk solutions. Banks and e-commerce firms are deploying AI tools capable of spotting patterns typical of coordinated fraud networks, moving beyond simple rule-based flags to catch threats that might otherwise slip through the cracks. Other companies are rolling out integrated risk platforms that merge cybersecurity alerts, financial exposures, and supplier risks into unified command dashboards, giving executives a panoramic view of their vulnerability map. Where risk management was once an isolated, back-office activity, it now acts as the central nervous system of the enterprise, alerting leadership to anomalies and enabling swift course corrections. The message is clear. In 2026, effective risk management means continuous, tech-enabled vigilance. The reward for those that excel isn't just fewer crises, it's also a competitive edge in an era when stakeholders value stability and adaptability. A new failure to prevent fraud law now makes corporations explicitly liable if they don't have adequate fraud controls in place, effectively turning robust risk management into a legal requirement. Similarly, regulators in the United States and Asia have intensified oversight of data protection, operational resilience, and supply chain risk, expecting firms to document their risk assessments and incident response plans. Major enforcement actions are driving the point home. Just this month, an Australian regulator slapped a global bank's local subsidiary with a $35 million fine for failing to act on scam transaction warnings. A stark reminder that lapses in risk oversight can swiftly translate into legal and financial peril. This alignment of risk management with legal compliance underscores how integral has become in preserving corporate value and public trust. Companies that invest in strong risk and compliance infrastructure today are not only avoiding costly penalties, they are positioning themselves as trusted, future-ready market leaders. In a fast-moving world, a mature risk culture serves as a force field, enabling organizations to pursue bold new opportunities, even those in uncharted territories, with confidence that their defenses are space-grade and their navigational charts up-to-date. B2B payments and infrastructure fintech, mega mergers ignite the race to a global payments superhighway. The business-to-business payments sector is undergoing a wave of consolidation and innovation as companies race to build seamless, always-on payment networks for the digital economy. In a blockbuster move making headlines, Canada's Nuvei has agreed to acquire US-based Payoneer, a cross-border payments platform widely used by international e-commerce merchants, for a massive $2.75 billion. This proposed takeover, if approved by regulators, would create a cross-border payments powerhouse poised to serve the exploding demand for real-time global commerce and small business trade. Meanwhile, another high-profile deal saw Dutch payments giant Adyen striking a $335 million agreement to buy a Silicon Valley startup specializing in AI-driven payment technology. By infusing its platform with advanced data analytics and automation, Adyen aims to stay ahead in an industry where intelligence and speed are key to processing the trillions in transactions that fuel global B2B trade. These mega deals underscore how the biggest payment players are scaling up and embracing cutting-edge tech to deliver faster, more secure, and more cost-effective financial plumbing for businesses of all sizes. As world commerce becomes more digitized and interconnected, new technologies are stepping in to satisfy businesses' demand for instant, frictionless transactions. One rising star is the stablecoin, a type of cryptocurrency pegged to traditional currencies like the dollar, which promises to revolutionize cross-border B2B transfers by offering near-instant settlement at a fraction of the usual cost. Analysts note that a stablecoin payment can clear in minutes for around 0.1% of a transaction's value, compared to traditional remittance fees that often exceed 6%, an astounding cost difference. No wonder firms in emerging markets such as Argentina and Nigeria have already processed billions in stablecoin transactions to sidestep currency volatility and reduce bank fees in paying overseas suppliers. Global payment networks are taking notice. Established players from Visa to new fintech entrants are integrating crypto wallets and stablecoin payment options for their business clients, essentially building a 24/7 digital cash highway that runs parallel to legacy bank routes. The industry is also adopting so-called multi-rail infrastructure, blending bank wires, real-time domestic payment systems, card networks, and blockchain rails, to ensure that funds can flow as seamlessly across continents as data flows across the internet. This push to innovate is not just about efficiency. It's about enabling the next era of trade, where even small exporters and online sellers can reach buyers anywhere in the world without worrying about payment delays or exorbitant fees. Not surprisingly, regulators are keeping a watchful eye on the rapid evolution of B2B payments. Financial authorities across jurisdictions are updating their policies to accommodate these new technologies while safeguarding against misuse. In the European Union, lawmakers are advancing streamlined digital finance rules, including an overhaul of payment service directives, to foster cross-border fintech innovation under robust consumer protections and anti-money laundering standards. In the United States, regulators are evaluating clearer oversight frameworks for stablecoin providers to ensure that these digital dollars are secure and fully backed, which would pave the way for wider corporate adoption. Meanwhile, central banks from China to India are launching or expanding their own instant payment networks and even experimenting with central bank digital currencies to modernize how money moves through the economy. The hope is that smart regulation will enable the benefits of a borderless B2B payment ecosystem while minimizing risks, building trust so that businesses large and small feel confident relying on these new rails. By collaborating with authorities, the fintech pioneers constructing this global payments superhighway aim to ensure it is not only fast and efficient, but also safe and legally sound. As commerce hurdles into the future, possibly to markets beyond Earth, today's B2B payment innovators are laying the groundwork for a world where paying an overseas supplier is as instantaneous as sending a text message, fueling growth for enterprises and entrepreneurs everywhere. RegTech, regulatory technology, AI versus fraud, compliance in a new space race. In the high-stakes world of compliance, technology has become both a sword and a shield. The RegTech sector, where regulation meets innovation, is booming as companies grapple with an avalanche of rules and a new breed of tech-savvy adversaries. E-commerce and fintech firms handling millions of transactions are turning to advanced software to automate compliance tasks, monitor activity, and verify customer identities at scale. The stakes are enormous. With data breaches, money laundering risks, and privacy mandates on the line, effective RegTech solutions can mean the difference between business as usual and costly regulatory sanctions. But the bad actors are evolving too. Sophisticated fraud rings now deploy deepfake identities and AI-driven schemes to slip past outdated verification procedures, forcing compliance teams to continually upgrade their defenses. There's a palpable sense of urgency akin to a high-tech space race. Only here it's regulators and financial institutions racing against digital fraudsters to harness advanced technology faster and keep financial systems safe. The past week has seen major moves in the RegTech arena, reflecting both consolidation and the quest for cutting-edge capabilities. Global consulting giant Accenture announced a bold $4 billion plan to acquire cybersecurity firms, aiming to fortify critical financial infrastructure against surging cyber threats and ransomware attacks. In the identity verification realm, US-based provider SailPoint revealed plans to buy an Israeli startup specializing in AI-driven identity security, underscoring the importance of locking down digital credentials as more customer interactions move online. These high-profile deals mirror a broader trend. Large players are absorbing niche RegTech startups to rapidly scale up artificial intelligence, data analytics, and advanced fraud detection features. The message is clear. In this era of instant digital finance, regulatory technology must evolve at light speed to outmaneuver criminals and give companies the tools to meet compliance demands without strangling innovation. From a legal and regulatory perspective, authorities are also leaning on technology as they intensify crackdowns on financial misconduct. Enforcement agencies worldwide are mandating more robust compliance protocols and even launching their own tech initiatives. For example, regulators in Asia and Europe have started standardizing real-time data reporting so companies can feed transactions into AI-powered monitoring systems for quicker anomaly detection and reaction. This month, Australia's financial watchdog hit banking giant HSBC's local unit with a $35 million fine for failing to prevent scam transactions. Stark evidence that missteps in compliance can bring steep penalties and damaged reputations. Officials from the US to the EU are urging businesses to implement modern tools, from automated risk scoring to continuous KYC, know your customer, checks, to keep up with evolving laws in anti-money laundering, consumer protection, and even upcoming AI governance standards. By partnering with RegTech firms, companies hope to stay one step ahead of these requirements, preventing violations instead of scrambling to fix them after the fact. If done right, the convergence of legal mandates and technological innovation carries a hopeful outlook. New RegTech solutions can empower businesses to grow and innovate confidently while safeguarding customers and financial markets. In a world hurtling toward a hyper-digital future, an effective compliance framework will serve as the navigation system that keeps the rocket of progress on a safe trajectory, proving that, with the right tech, we can reach for the stars without losing our way. Institutional trading and market infrastructure. High-speed markets chase 24/7 access and new horizons. Global trading systems are rapidly modernizing to match an era of near-constant market activity and digital assets. Exchanges and trading venues are upgrading their technology, from faster settlement cycles to expanded trading hours, to keep pace with an always-on economy. Across Asia and the Middle East, some stock exchanges are piloting longer sessions and cross-border listings, reflecting demand from investors who don't want to be constrained by traditional market hours or national boundaries. Analysts predict that major markets may soon operate almost 24/7, narrowing regional gaps much as satellites have narrowed global communication distances. Meanwhile, the rise of cryptocurrencies and tokenized assets in institutional portfolios is forcing traditional market infrastructure to adapt to new asset classes and round-the-clock trading behavior. It's all fueling an expansion of market reach. Like explorers opening celestial routes, market operators are building systems that make access to capital markets as broad, instantaneous, and borderless as the internet itself. Recent developments show how quickly this once-staid sector is evolving. A blockchain-based trading platform recently executed its first large block trade for an institutional client, a milestone hinting at growing Wall Street interest in decentralized finance and on-chain market infrastructure. In the Middle East, the Abu Dhabi Securities Exchange, ADX, just hosted its region's first initial offering of a US-based exchange-traded fund, cross-listing a Sharia-compliant ETF originally launched in New York, thereby expanding local investors' global options. Meanwhile, trading firms are pouring resources into more resilient systems to handle surging volumes and volatility. A recent industry survey found that a majority of quantitative trading shops faced data slowdowns in peak periods, prompting heavy investment in ultra-low latency networks and robust market data pipelines. much like aerospace engineers reinforcing rockets to withstand extreme conditions. Market infrastructure teams are making sure their trading engines can weather the intense bursts of activity that define modern markets without sacrificing speed or stability. From a regulatory perspective, authorities are stepping up to ensure these advances come with proper safeguards. U.S. regulators, including the SEC and CFTC, have signaled greater coordination to craft unified frameworks for digital asset trading and innovative venues, an approach meant to manage risks while encouraging beneficial market innovation. In Europe, regulators are rolling out updated trading rules and crypto-specific regulations to extend investor protections and transparency to novel products and 24/7 operations. Even the venerable back-office processes are getting a high-tech upgrade. One pilot project recently used a central bank digital currency to settle bond trades instantly on a blockchain network, hinting that tomorrow's transactions could clear in seconds instead of days. These moves show that global watchdogs recognize that updated guardrails must accompany the leap to high-speed, global markets. The collective hope is that an upgraded, inclusive financial ecosystem will soon emerge, one where markets never sleep, trades settle almost as fast as they're made, and opportunities reach people across the world, and maybe eventually beyond Earth, without undue friction, all under the steady guidance of robust international regulation. Disclaimer: the information in this forward-looking news report is for informational purposes only and does not constitute legal, financial, medical, or official advice. These anecdotal news stories are presented as analysis and commentary. They should not be relied upon as professional guidance or instructions of any kind. Video description: a comprehensive forward-dated financial news roundup covering 5 major topics shaping the future of the stock market and fintech landscape. We explore how corporate CFOs are leveraging AI and even stablecoins to optimize treasury and cash flow management, and how enterprise risk management is turning crises into catalysts with cutting-edge analytics. We delve into massive B2B payments mergers fueling a global fintech boom, examine how RegTech innovation is battling fraud and boosting compliance amid tougher regulations, and report on institutional trading infrastructure racing toward 24/7 markets and new asset classes. This deep dive 20-minute financial news report offers insightful analysis of today's top trending fintech and market stories with a hopeful, tech-forward perspective.